If you're getting close to retirement with at least a couple $1,000,000 saved, chances are you carry some version of this fear. And the fear is, what if I run out of money? But here's what I've seen after 31 years. With families who have built real wealth, the opposite problem is far more common. It's not running out of money. It's never even coming close to running out. This pattern is so widespread that one study in the Journal of Financial Planning actually gave it a name. They called it the consumption gap. It's the gap between what a family could safely spend from their portfolio and what they actually end up spending. And the consumption gap, it wasn't small, it was enormous. So in this video, I'll show you how common this really is, why it happens, and the best way that I've found after working with hundreds of families to help you spend more without feeling reckless. My name is Chris McClure. I've been a financial advisor for 31 years, and I put these videos together about once a week, and it's honest information for high net worth families who have worked too hard to leave money on the table. So let's get into the study here. The Journal of Financial Planning looked at how retiree spending actually changed over time through the decade of the 2000s. And the results were nuts. They were striking. Affluent retirees who were relying on their portfolio were failing to even spend their annual income. See, that's their guaranteed income, their pensions and Social Security. Even that wasn't being fully spent, not to mention the portfolio. So they were actually saving a portion of their pension and Social Security. And remember the window here. This was 2000 to 2008, and that was a really rough stretch for the markets. You'd expect these portfolios to shrink as people took their withdrawals, but that's not what happened. On average, the assets of these wealthy retirees still grew during retirement, even in a mediocre to below average market. You see, that's the consumption gap in action. All of these families not spending their pension, not spending their Social Security, missing out on all kinds of fun things they could do, but instead they're saving. For families in the top wealth percentiles, actually spending was well below what their asset base could support. They were spending so little that on average, their portfolios kept growing. And even when the researchers set aside a huge chunk of their assets for longevity, for medical costs, for legacy, the gap was still substantial. Now, I know what you're thinking. Why do we keep saying wealthy? What's actually wealthy here? In this study, wealthy meant roughly the top 20% of retirees by net worth. And if you bring that into today's numbers for ages, say, 60 to 65 or so, you're looking at around $1.6 million in net worth to land in that group. So if you're heading into retirement with $2 million or more, you're very likely in or near this group. And the data says your biggest risk, it may not be spending too much, it may be spending far too little. You see, these families are rich on paper, and yet their spending reflects a completely different reality. And that was exactly the case of a couple I sat down with not too long ago, David and Cynthia. David was 60. He'd spent his career running a manufacturing and distribution business. Cynthia was 58, and she was a retired orthodontist. And after 3 decades of saving, their brains were not magically ready to switch from protecting to enjoying. See, they were used to watching their portfolio grow and never touching it. On paper, everything looked perfect. 2 strong careers, both sharp, both diligent. They had about $3.2 million in their portfolio. They were set, but both of them were still terrified. They'd retired without an advisor. They had done hours of research on their own, and they still couldn't bring themselves to spend beyond the bare minimum. They checked their accounts constantly. They followed the markets. They were watching CNBC. They told me they actually checked their accounts hourly some days. Unfortunately, they said no to trips with their adult kids. You see, they were cutting back in small ways that just didn't match what their financial reality was. Financially, they were completely fine, but emotionally, what they were doing was dangerous because they were as healthy as they're ever going to be in their 50s. And they were burning through those healthy years, and they're years that they'll never get back. So we sat down together, we ran some projections, we stress tested different market scenarios, and in every realistic scenario, at their current spending, they were on track to leave multi-million-dollar inheritance for their kids and grandkids, even in below average markets. And here's the part about David and Cynthia that I see with so many families. They were living on about a third of what they could actually safely afford. And they really had no desire to leave a big inheritance. Their kids were safe. They were doing well financially. They didn't need money from mom and dad. This money was for them. It was to enjoy their retirement, to exhale after having decades of demanding careers. They wanted to actually live the life they'd built. And that gap between what they could spend and what they were spending was enormous. I mentioned earlier, the researchers call that the consumption gap. I like to call it the enjoyment gap. It's what you can spend minus what you allow yourself to spend. And that enjoyment gap is a very real opportunity cost. It's not just a line item in a spreadsheet. It's how much of your own life you're missing out on. I've watched it dozens of times and it doesn't feel routine. And from what I see, this gap is driven by two forces. The first is a savings habit, and it becomes an identity. I gotta save, I gotta save, I gotta save, right? My net worth has to go up. I'm not comfortable if I'm spending money. A lot of wealthy families have what I'd call an accumulation addiction. You see, for decades, you're rewarded emotionally and financially for protecting your assets, growing them, never touching the portfolio, not spending too much. So of course, spending it down, it just feels wrong. And drawing from that portfolio isn't just a financial decision. It feels like breaking one of our core habits, right? And it's a core habit that has served you incredibly well for 30 years. In general, we're excellent at it. We're excellent at saving. We're excellent at growing our retirement. And in retirement, the expenses come and it asks you to completely reverse your mindset. The second force, besides that accumulation addiction, the second force is fear. Specifically, fear of all the unknowns in retirement. You're not really worried about today. You're worried about later. What if I need long-term care? What if my health declines and the cost spikes? What if the market crashes at the worst possible moment? What if I'm 85 and I can't make ends meet? Most families, they justify it the same way. They say, I'd rather have too much than risk not being able to pay the bills in my 80s. And I completely understand that. Trust me, I get it. It feels like a very real fear. But here's the problem. Most families aren't spending anywhere close to that catastrophic level. They're often well below what research would even call a conservative withdrawal rate. A 2024 study looked at married 65-year-olds with at least $100,000 in financial assets. On average, those couples were withdrawing about 2% from their portfolio. You see, that's roughly half of what many conservative safe spending guidelines suggest, even under bad market conditions. Behaviorally, that's classic catastrophizing, and it leads straight to deep underspending and a massive enjoyment gap. And the bottom line is, in retirement, you want to have as much fun as possible, not have an enjoyment gap. And if you're watching this and already wondering how your own picture stacks up, there's a link below. You can schedule a call and I'd be happy to chat with you about it. The good news is there's a way to break these savings habits and calm the fear of all those unknowns, but it takes a real change in how you see your money in retirement. The first change, I think, is defining your rock bottom spending level. With David and Cynthia, we went back to basics. The question wasn't how much you could spend in a perfect world. It was, what's your rock bottom? What's the spending level designed to survive the catastrophe in your mind, the things that you're really worried about? Now, you've probably heard about the 4% rule. Very simply, it came from research asking a question. If someone retired for 30 years, started by withdrawing 4%, and raised that dollar amount each year with inflation, would they have run out of money in the worst markets we've ever seen? Historically, with 4%, the answer is no. They don't run out of money, even with the horrible markets. So 4% isn't some aggressive target. It's not an average, it's a floor. It is Great Depression level withdrawal rates. And the research actually goes further. Starting at 4%, more often than not, you end up with more than your original principal after 30 years. So when people talk about the 4% rule, they miss the point. It's built to survive brutal conditions. And that one shift alone, it helps a lot of families. A bad market is not going to sneak up on you silently. If you retire into something like a 1929, the first year of the Great Depression, you're going to know things are rough and you'll have time to respond. And here's the kicker. At a 4% start, it's more likely you'll have room to increase your spending over time. You're not likely to have to hold your spending at 4% for the rest of your life. Now, I want to address one more elephant in the room here, because I work with a lot of families who retire early. Maybe they retire at 55 or 60. And that means a longer time horizon than the standard, say, 30 years. If you're retiring in your 50s, like maybe David and Cynthia I mentioned earlier, you might be planning for 40 years or more. And as that stretches out, the floor doesn't collapse, it just drifts a little lower. So for a lot of early retirement plans, the floor is maybe closer to 3.5% as opposed to 4%. But no matter your time horizon, that's the bottom level that you could safely spend. So if we want to be conservative on a 40-year retirement, instead of 4% as the worst case, maybe we drift down a bit, down to 3.5%. And that gives you a clear Math-based minimum. If things ever feel scary, this is what I'll still allow myself to spend. Anything above it is optional, but that floor is mine to use. So with David and Cynthia, we used that research to find their rock bottom number. Their lifestyle still held up under severe stress. And then we wrote it down. It was in their financial plan in bold. It said every year in retirement, we give ourselves permission to spend at least this amount, adjusted for inflation, even when the headlines are scary. That clarity alone started to shrink their enjoyment gap, right? They started having more fun. They went on those trips with the kids. They went on a cruise. They went to Europe and had a ball. See, that's the floor, right? The second thing is the bonus. The second thing I like to talk about is the bonus spending. One of the biggest real risks in retirement is retiring into a bad market. You see, the first decade of returns can set the whole tone for retirement. And that's what we call sequence of returns risk. Most people try to handle it by hoarding cash. They overload on bonds. They never increase their spending. They just have a bunch of cash in the bank. But research shows one of the most powerful defenses isn't hiding from the market, it's being flexible on your spending. So if the markets are down, maybe you don't go on that cruise. The risk isn't that you spend money. Your risk is if you're spending too much that you refuse to adjust, which as we've seen is not the problem these families have. So I like to do two things. First, you want to separate your spending into core expenses and joy expenses. Core is the stuff that can't go away. A mortgage, if you still have one, let's say it could be a mortgage or rent, insurance, groceries, utilities, healthcare, those are things that are non-negotiables. And joy sits on top of that. Things like travel, gifts, right? A first-class upgrade to Europe. That's fun money. The things you could dial back if you ever had to. The thing is you can actually adjust the joy spending based on what's happening in the market. Not based on what's going to happen next, but what's actually happening right now. There's one idea that I really like, and it's inspired by Nick Magliuli's flexible spending work. It looks like this. Let's say your base spending is $120,000, and that's the number you never want to drop below. 10 grand a month. And if you've got another 40,000 on top, which we call your joy spending, so your total potential spending is 160,000. Each year you look at where the market is relative to its recent high, and you adjust only the bonus, only the joy expenses. If the market's within 10% of its all-time high, then you spend 100% of your joy budget. If it's down 10 to 20, you spend half. If it's down more than 20%, you pause joy spending for that year. Psychologically, it does two things. Number one is it gives you permission to fully enjoy your lifestyle in normal markets. And it gives you a simple rules-based way to pull back when things get rough without panicking or guessing. Now, the third change is to get honest about what you're actually giving up. And here's the truth I share with a lot of high net worth families is by spending so little and saving so much, you're not avoiding being a burden on your children. You're guaranteeing that you never get to be the beneficiary of all that money you worked for, all those years you saved, all those years you cut expenses. You're not going to be able to enjoy it. Most high net worth families that we work with are overtrained savers and undertrained spenders. And it makes sense. You spent decades practicing restriction, discipline, delayed gratification. But using money intentionally, using it to support what really matters is a completely different skill. It's a skill you have to build, which means the identity has to shift. It shifts from protector and accumulator to wise steward and intentional spender. You don't have to flip the switch overnight. I realize it's hard, but you should start, and you can start small. Maybe pick one or two areas where you'd like to enjoy your money more. Maybe travel, family experiences, having more free time. I want to fly fish. That's what I want to do. Set very specific rules for how you'll spend there. And then this is the uncomfortable part. Keep those promises to yourself. You might set a rule like, if my plan is above 95% success rate, I'll increase travel by this amount every year. Or if markets are within 10% of their highs, I say yes to the trips with my kids and grandkids. Because for disciplined savers, the fear that your spending will suddenly spiral out of control is almost always the opposite of reality. It's just not going to happen. After working with families for 31 years, and here's what I found. Your real retirement risk, it's not running out of money. It's never letting yourself enjoy it. So if you'd like help turning your savings into real sustainable spending plan, one that protects your wealth and actually upgrades your lifestyle, there's actually a link below to set up a call. We'll look at your numbers, we'll look at your goals, we'll help build a plan that balances security with enjoyment. I'd be happy to chat. You didn't save all this money to worry about it. You saved it so you could finally live with it. Hopefully this is helpful. I really love making these videos, and I'll see you on the next one.